Markets hate uncertainty. And right now, the world is swimming in it. From overnight military escalations to surging oil prices, the pressure is mounting. The big question is, how will this affect the Indian economy and your investments? Hi, I'm Ananya Verma, and you're watching India Market Watch. If you care about how global developments impact your money, subscribe now and stay informed with sharp, actionable insights. Let's break down what happened. According to the insights I've gathered from financial market trackers and geopolitical sources, the situation that unfolded overnight has sent ripples through the global economy. The US has taken a limited military action in West Asia, triggering fears of retaliation from Iran. While the full details are still emerging, market reactions have already begun. Indian indices are expected to open about 1% lower, and the rupee may see short-term weakness against the dollar. But what's really in focus right now is oil. India imports over 80% of its crude oil. So naturally, even a $5 spike in oil prices can significantly pressure our current account deficit. Crude has already jumped nearly 15% in the last 2 weeks. If the situation escalates, we could see Brent cross $90 per barrel. That's a psychological and economic red flag. According to the insights I've been reviewing, analysts suggest India can comfortably manage crude under $90. But if prices breach $100 and stay there, we are looking at real consequences: currency weakness, inflation, and tighter fiscal space. So what should investors watch out for? Based on current patterns and sentiment analysis, we are likely to see weakness in sectors sensitive to oil prices like aviation and transport. But here's what's interesting: these sectors don't carry much weight in Nifty or NSE 500. The index is dominated by financials, IT, and large-cap consumption stocks, which are less exposed to immediate oil volatility. In fact, many long-term investors see these dips as buying opportunities, especially if you're looking at a 3-year plus horizon. Here's some historical context I've pulled. In most modern conflicts, markets react negatively in the short term, but often recover once the worst-case scenarios don't materialize. Take the ongoing Russia-Ukraine conflict. While it hurt Russia's domestic markets, global indices, including India's, have shown resilience. Another key variable is the rupee. If crude spikes and the dollar strengthens, the rupee could weaken, which may push import costs higher. This would hit not just fuel, but also food inflation. As per RBI's current position, there is enough foreign reserve buffer to manage short-term currency volatility. But a prolonged crisis could require policy tightening. That brings us to the macro view: fiscal deficit, inflation, bond yields. If oil goes past $100 and stays there for more than a few weeks, the government may need to intervene. Subsidies, fuel price control, or tighter monetary measures could all be on the table. Geopolitical risks are part of investing in today's world. But preparation beats panic. If you found value in this analysis, hit that subscribe button. We simplify complex financial news into real, usable insight every single day. Let me know in the comments, are you buying this dip or waiting on the sidelines? This is Ananya Verma for India Market Watch. Stay sharp, stay invested.